let's come to the relationship between the Japanese equity market, Nikkei, and the yen. Now, before we talk about the Nikkei, we really need to understand what drives the yen. A very simple way of looking at the currency depreciation or appreciation, here we're talking about the yen, is difference between interest rates between the Federal Reserve and the Bank of Japan. Now, the Federal Reserve and the Bank of Japan, Federal Reserve's interest rates are currently somewhere close to 5.5%, and the Bank of Japan's interest rate is at 0.25, which means it's a fair bit of gap between the Federal Reserve's interest rate and the Bank of Japan's interest rate. Wider this interest rate, weaker will be the currency. And smaller this difference in the interest rates, stronger will be the currency. What we have seen over the last decade or so is you have actually seen the difference between the Federal Reserve's interest rate and the Bank of Japan's interest rate widen, which has structurally given a directional weakness for the yen. So as the yen continues to weaken, the Nikkei continues to go higher and higher. Now, what is the relationship there? Because a very large chunk of the Nikkei index, the weights of the index, are assigned to Japanese export-oriented companies that always benefit when the currency weakens. Now, if you look at the slide here, three very key sectors that have very large weights in the Nikkei are automotive, electronics, and machinery. So over the last 10 plus years, as the yen continued to depreciate, you started seeing a fair bit of strength in the Nikkei driven by largely these sectors. First week of August, for the reasons that we spoke about earlier, your non-farm payroll numbers in the US started coming off. And just before that, the Bank of Japan raised interest rates one more time. The first time it raised interest rates was in March of this year, and then it raised interest rates in the last week of July. After that, you have started seeing an appreciation in the yen. We spoke about, remember, we said the minute the gap between the Federal Reserve's interest rates and the Bank of Japan interest rates starts coming down, the currency gets stronger. And as a result of that, you started seeing an appreciation in the yen. And the carry trade that we talk about, that started unwinding. We'll talk about the carry trade in a bit. This differential between the Federal Reserve's interest rates and the Bank of Japan's interest rates, from a market point of view, can actually be seen in this chart here. As and when you see the yield differential increase, you see the yen weaken, the yield differential comes down, the yen strengthens, yield differential starts going up again, the yen starts weakening again. And like we talked about these sectors here, automotive, electronics, and machinery, you can see that the directionality over the last 10 years plus, when you saw a very sharp increase or depreciation in the yen, the Nikkei moves almost hand in hand, largely because a weaker yen means a stronger Nikkei, because the heavy weights in the Nikkei are largely these three sectors. Now let's come to what happened in the first week of August. You started seeing a sharp drop in the dollar, and you started seeing the yen appreciate because the Bank of Japan raised rates already 2 times in the past. One in March and one the last week of July. As a result of that, markets started expecting, one, a recession in the US, which means they started expecting that the dollar would start getting weaker and weaker. And second, they felt that the Bank of Japan would continue aggressively raising rates, which meant that they started expecting the yen to start entering a phase of sharp appreciation. A sharp appreciation in the yen would mean what? Would mean that the Nikkei could start reversing because of yen strength. Now, this is largely the relationship between the yen and the Nikkei.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.